Rahul Singh of Tata Mutual Fund joins us right now on the show with his thoughts. Rahul, good having you. Thanks so much for taking the time out and speaking to us. What are you doing, Rahul? The temptations might be there to deploy cash with the SIP monies that would be coming in. Are you guys even remotely thinking of trying to sit on a bit of cash because of the uncertainty?
So I think different funds are in different stages of cash deployment, so one cannot give a general statement. But yes, I think what we are focusing on in this mayhem also is that what are the sectors or stocks which would actually benefit when the dust settles? And clearly the sectors which would benefit from lower crude prices is one sector which is clearly coming out. So whether it is autos, cement, maybe part of consumer goods, paints, gas utilities, which will benefit from lower gas prices globally if there is a slowdown. So I think there are pockets which would benefit when the dust settles down, as I said, and even if we are deploying cash, we are deploying mostly in those segments. Apart from the large caps, which were anyway in our shopping list and where the valuations have again now become quite reasonable. So we are doing it gradually. I don't see that being a big kind of a rushed kind of a deployment, but clearly we can see that fundamentally there are pockets where I think barring the next 1 or 2 months of uncertainty, if the virus really spreads within India, then we will have a slowdown of our own. But I think the benefits of a global slowdown are also going to be there when everything is kind of on a more steady state scenario.
Okay. The other question, Rahul, is that even if people want, the conversation thus far has always been what should people buy, as would be the case when the markets dip. Because of the uncertainty around this and the impact it could have on consumer businesses, can there be a question of what to avoid and not from the usual bucket? I know commodities maybe should be avoided, though there are counter views there, or some of the other usual suspects should be avoided. But are there pockets wherein you are contra the street right now, wherein you believe the earnings decimation is not being priced in as yet?
So I think the discretionary side is obviously looking little dicey in terms of how the consumption would pan out if the virus were to really spread. I think that is one area to watch out for consumption. Also, not only because of the earnings, but because the valuations there are quite demanding. So if we see a certain change in the way the industry was working as a result of this, even when the temporary slowdown reverses, and we see certain companies not being able to adapt to a change, whether in terms of their digital capabilities or their ability to adapt to online way of working, etc. I think those are the segments where we need to be careful on. At this point of time, it's very difficult to say whether the earnings are pricing in that or not, or whether the stock prices are pricing in that or not. But that is one segment which is definitely vulnerable, and we have seen that in China that during those 3 months or 2 months, the discretionary consumption was the one which was worst affected, starting from travel and leisure, but affecting other segments as well.
Okay. Rahul, as and when we make a bottom to the market, can't really pinpoint when that happens, but it looks like this could well continue into the upcoming quarter and maybe one quarter after that as well. But at the first telltale signs of a recovery, what do you think is going to bounce back with full gusto?
So as I said in the beginning, I think the stocks or sectors which are going to benefit from lower commodity, lower crude prices, and the resultant impact of that on their structural fundamentals are the ones which will bounce back more. Also, one we have to realize that when we look at banks today, this is also going to make funding more and more difficult for the smaller banks and the NBFCs. So the bigger banks will become stronger. I think they can bounce back harder, along with the sectors which I mentioned earlier, which is autos, cement, gas utilities, paints. These are the sectors which are dependent on crude or crude-related derivatives for their raw material, or metals as their raw material. And in some cases, for example, in autos, the cost of vehicle ownership will come down. Although government has raised excise duty, I think there is still a lot of room for the retail fuel prices to keep coming down. And those are the things which are going to be the silver lining when the bounce comes.
Yeah, when the bounce comes. I mean, the multiple things spoken about, right, Rahul? I mean, this Nifty forward price to earnings and price to book at multi-year lows, and how we are above or below the historical averages. The problem has been that even though we may be trading at those levels, the duration for which these levels or these lower levels could last, even when you look at history, are pretty long. So the levels may be good to buy. The problem is the time, and that's my question. Therefore, that even if you're convinced about levels, would you essentially spread out your investments as things stand over weeks or over months? Or would you be deploying, as a lot of people are saying, that let me deploy 30% right now, then I'll deploy another 20% in the next 1 month, and then take it as it comes?
No, that's a good question, but let me break it down and give you the answer in a different way. Instead of looking at cash deployment, whether it should be 10% now, 20% now, 25% now, and keep reserves, from a institutional investor or mutual fund perspective, I think the key here is, are we coming to a stage where some of the sectors or stocks which had not done well for the last 2 to 3 years for a variety of reasons, could those be the sectors which could come back? And some of the sectors which I mentioned to you as sectors which would benefit are some of those sectors haven't really done well over the last 2 to 3 years. So I think if you look at deployment, one is the cash deployment, which I've already told you how we are going about it. But within the portfolio, today the reaction is pretty much indiscriminate. I mean, the stocks which had anyway not performed in the last 3 years have also corrected as much as probably the stocks which have done well over the last 3 years. So right now the reaction has been pretty indiscriminate. We would expect that there will come a time in this phase of correction when the market starts differentiating between sectors which are going to benefit from this scenario, number one, or sectors where the valuations have come to a point where in the current context, when the bond yield globally has gone to 0%, that a 5% or 4, 5%, 6% dividend yield suddenly becomes attractive. So we have to be cognizant of those macro changes which have happened in the market, and therefore try and align our portfolios to either the sectors which are going to do well or the sectors where the valuations have become extremely attractive, and trying to avoid or move out of sectors which could get impacted if discretionary consumption continues to take a hit. So those are the three ways in which the portfolio will have to be reconstructed, rather than thinking about it only in terms of cash. Because when you're thinking about only in terms of cash, you're assuming that everything goes up with the same force. That need not be the case.
Okay, one more question, Rahul, and that is on the high quality financials, which are now starting to take the bitter end of the stick, and fair degree of fault there, despite commentary is not looking all that bad. I mean, Bajaj Finance in some virtual tour with Morgan Stanley mentioned that they have not been impacted at all thus far because of COVID-19, which is not to say they won't get impacted, but the fact that they haven't gotten impacted thus far, which means that numbers so far are in good hands. And these are tried and tested businesses, right? Bajaj Finance, ICICI Bank, Kotak Bank, HDFC Bank, but all of them are now starting to fall really hard. Would those be the first ports of call for large investors like yourself?
Well, as I said, I think the prices for these, the fundamentals for these companies or stocks actually is getting better, because the way the funding cost is going to be for NBFCs and smaller banks, especially after the Yes Bank episode, is that the larger banks will become stronger. So there is no really dent in their competitive positioning. I think the stock prices tend to get driven by maybe high FI ownership and marginal selling, and not enough marginal buying from the domestic mutual funds in those names. So therefore, I think that will play out. The technical part of how the stock markets and the stock prices behave will play out. I think the fundamentals are playing out. I don't see any kind of dent in their except for the fact that there could be a slowdown in the consumption spending near term on some of the names which you mentioned. Even if they are not seeing an impact today, they might see an impact in the next few weeks. But that's a temporary blip, because overall, structurally, they are going to get stronger, given the way the discrepancy or the dichotomy is between AAA high quality debt cost versus anything which is lower than that.